I've just got a couple of notes before we jump into the material. So this is webinar number 10. And for those of you that are just joining us for the first time, these are all building blocks of education that augment our main course, How to Buy a Good Business at a Great Price. Most of the people that join the webinar are our existing clients, and we're glad to have any newcomers. That's always wonderful. You're always welcome. We're going to do another Q&A, open Q&A next Friday. This is for our existing clients, and I had those originally scheduled every 2 weeks. However, I got some emails from individuals asking me if we could have them more frequently. So either if you want to I've got a lot of people with their cameras off, but if you want to drop me an email, if it's something that you want to move to every week for clients Q&A, happy to do that. And we'll just get a consensus from everybody what time, whether we do it in the evening. But the next one will be on June 21st. Or I believe on June 21st. We'll send out an email to everybody. And again, if you want to have more regular ones, happy to do them every week. For those of you that are just joining for the first time, because this is webinar number 10, and the second part of our due diligence, go to the YouTube channel. CEO will post the link up afterwards. And all of the prior webinars are there, and highly encourage you to watch the first part, because we're going to, especially related to the due diligence, we're going to refer to that quite a bit. And so you'll understand what it is. They typically are around a couple of hours. The last one we covered getting prepared for the process, and we talked about assets and systems within the business. The goal of these webinars is to teach you practical real world advice and strategies. We don't cover anything related to all some nonsense that you see online about buying businesses for, throwing off $500,000 a year for zero down and closing deals in 12 days. That's not what you learn here. This is just practical real world experience. My goal with every one of my clients is to have you buy a business within 6 months from the day you start together with us until you close a deal. And we have a formula called 44411, which should take you 4 months to identify the business. During that period of time, you should be working with a maximum of 4 categories, and you have to make at least 4 offers. That's the falling off point that we've learned from data from hundreds of thousands of individuals looking to acquire businesses. If you don't follow those data points, you're likely going to fall into the other camp of the 90% plus that never complete a transaction. And so you want to follow that formula and stick to that. If you're doing this on a part-time basis, that can take you a little longer potentially, but you certainly have to devote anywhere from 15 to 20 hours a week. The 44411, we cover the first four part. The one after that is a month to negotiate and a month for due diligence. So all in all, should take you 6 months. Is it possible that it could take you an extra month or 2 for the latter part of negotiation and due diligence? Yes, but the target should be 6 months. 6 months. Anybody who's on this call who's been looking for longer than 6 months, we really need to get you to adjust your approach. And certainly if you've been looking for 4 months and you haven't narrowed down the categories of businesses or nailed one particular business and haven't made at least 4 offers during that period, again, we've got to help you adjust your approach because you're heading off the reservation. We'll have a full Q&A towards the end. We'll have one in between a couple of sections. I will have another Q&A, and the goal with the Q&A is we want to get you, for any of you new individuals, to understand how our community of clients work. We have our regular Q&A sessions, and we have unlimited consulting with me. So I want you to get a flavor and for how that works. At the same time, today is not an infomercial for our product. We're happy if you join our community. If you don't, that's fine too. You're always welcome here. I think you're a little crazy if you don't invest the time to learn how to buy the right business, because what happens to people is especially during due diligence, as you will see, if you aren't properly prepared for this process, and especially during due diligence, you end up getting towards the end of the due diligence period, and either you overlook something and end up making a catastrophic mistake, or you don't complete the task and you feel uncertain and you abort the project. And what happens is you end up missing out on opportunities. So you have to do this in a very diligent manner. Due diligence is a pretty good name for it, because you really have to be diligent during the process. And likewise, during the whole process of buying a business, if you don't have a high if a high level of knowledge related to the buying process, you're going to lose deals. I mean, your competition is fierce of other buyers, and the educated buyers know how to move quickly. And if you're not familiar, not knowledgeable, the reality is you're just going to miss opportunities because you have to be able to move quickly. Good businesses hit the market and are typically under contract, in 30, 45 days. So you really need to know how to navigate your way through the process in a good way. And that's the purpose and goal of all of these webinars, to have you, I like to think of my community as a business buying battalion. We want you ready like Marines. Today, we're going to continue the second part of due diligence. The due diligence checklist in our program, the due diligence lesson is 49 pages. The checklist is a 200-item checklist, so we're certainly not going to be able to cover everything, but we'll cover some highlights and high-level items. And today we're going to discuss financials, the competition, and contracts. And again, for those of you who joined a few minutes late, please go back and watch the first part one, the first session on due diligence, because that, like every other one of our webinars, is a building block of education, and you really need that as part of part two as well. The other thing about due diligence, it's really a lesson in preparation for how you want to run your business when you buy it, because you want to be able to, when the time comes to sell, you want to be able to present your buyers with a business that's buttoned down, that's organized, has good books and records, and everything taken care of. All the things that you're going to scratch your head about while you try to buy a business, you want to get those things corrected in your own business. So when the time comes to sell, you could present a really viable business to a prospective buyer. It also helps you run your business more effectively during that time. I think that's all I have for our housekeeping items. So as my usual, as we say in Boston, let's get the party started. Okay, Sia, you can tee it up, and everybody, there's my trusted colleague, Sia. She's the brains behind all of this and keep me organized, and we'll get going. So the first thing I want to discuss is some of the key key pointers rather, that were discussed in part one, which are two stages to due diligence. One is the non-formal due diligence, which is as soon as a business becomes of interest to you, you've got to start your due diligence. And again, in the prior webinar, we talked about what you should be doing immediately, but there's certain areas and categories that you should start and must start investigating immediately. That'll not only prepare you properly for the discussions with the seller, but it's going to get you ahead of the curve, because you're going to see you have a limited time to conduct the formalized due diligence. So areas related to like the industry, the competition, the market, the initial review of the financials, you have to really dig into those early on. And again, the second a business is of interest to you, that's when you start. And please, just to reiterate again, for anyone just joined us, go back and watch the first session, because we dig into specifically what needs to be covered as soon as a business is of interest to you. Then you have the formalized due diligence period, which starts after an agreement is in place and executed between the parties, whether it's an LOI or a definitive purchase agreement. First things, you have to allow yourself enough time. You need a minimum of 20 business days. Do not let any broker talk you into a 1-week period or a 2-week period. You need a minimum for even the smallest business, for 20 business days, which is equal to a calendar month. You don't want to start the formalized due diligence until you have all the key documents needed to conduct your investigation. That means when due diligence starts, the clock starts. So when you have an LOI or definitive purchase agreement, you're going to indicate in there what you need to compile your due diligence, or your due diligence list will be submitted to the seller shortly thereafter. You do not start the clock until you have all the key information. If not, you're going to be running all over the place, missing pieces. So set the record straight with the sellers. Here's what we need. And as soon as that is in place, we will start the clock. And once the clock starts, you want to memorialize that, meaning you send notification to the seller. Today is, whatever today's date is, I've now received the documentation. The official due diligence period is now going to start. Your financial team, getting your accountant into place, making sure that they're going to probably give you a checklist. You're going to combine that with our checklist. and also the particulars to the business. And you're going to assemble one master checklist. Sia, could you just go back, please? Skipped ahead there. Thank you.
Sorry
For a
about that.
quality of earnings report, most businesses, you do not need a quality of earnings report. That is, a quality of earnings is a more robust discussion related to the financials. Very often, if there's lenders, investors involved, or an institutional business buyers, they want a quality of earnings. I would urge all of you to go find a generic quality of earnings report online, read it, you'll see what it is. It's a basic due diligence report that you could get from a CPA on steroids. That's what it is. A lot of filler. There's sometimes a lot of good information. Some investors, if you're dealing with investors, may ask you may ask that to be compiled, and that's okay. But generally speaking, you do not need that. You need just a comprehensive due diligence analysis by a competent CPA. Next, let's talk about the SIM or the deck that you get while you're when you're looking at a business. It's very important to understand how to read a deck, or a SIM, as they're often referred to, as a confidential information memorandum. The way I do them is I get a SIM, I read the whole thing first, I don't make any notes, then I go back a second time and I start to make my notes. And the reason is, often when you're reading it the first time, questions that you have get answered later. But also by reading it once in totality without making notes, you could focus on the business. It's a clear way to read a SIM. When you go back and do it the second time, you make your notes on the SIM into two separate categories. One category is questions for the seller or broker. The second one are what is it that I need to do? Because there's going to be items, they may mention something like the industry, is growing at an annual rate of 4.2%. Well, you want to investigate that or ask the seller. Or they say the competition is minimal in this geographical area. And as you see and we discussed in the prior webinar, where a seller talked about a minimal number of competitors, and we found 22 of them. So again, you have the SIM you make notes right on the SIM, questions to ask the seller, and then things that I or you, the buyer, need to do on your own. The goal of formalized due diligence is confirmatory, not exploratory. And there's a massive, massive difference. Confirmatory is you want to confirm what you've learned so far, whether it be related to the financials, the competition, the industry, the assets, the employees, the suppliers, the sales, the marketing, etc. You want to be able to do as much as you can beforehand so that you can confirm this during your formalized due diligence. If you look at due diligence as exploratory, it means you're trying to find all the information for the first time. The goal in due diligence is to validate what you've learned, and so you can go ahead with the deal or not. So you want to have that approach. Some of the best deals are the ones that you don't do. And what I mean by this is, don't get yourself caught in a situation where just because you've invested a lot of time into a deal, you forge ahead if it's not the right deal. No lost deal is in vain. You always learn something that you can take to the next deal. Lost or aborted deals happen. That's just part of the process. But understand, sometimes it's the best thing that could ever happen is being able to walk away from a deal. Not because you didn't do enough research to make sure to make a good decision, but because you decided that for whatever reason, there's too many problems with the business, or it doesn't make sense for whatever reason. But don't despair. Lost deals are part and parcel of the process. There's no escaping it. It's going to happen. I promise you. And don't be in despair. It's no big deal. You wipe yourself off and go on to the next one. Getting organized. If you're not organized, you're going to get to the end of the period of the due diligence. There's going to be too much that's not covered. You're either not going to be sure, and you're going to end up walking away from the deal and otherwise miss some very good opportunities. There's 3 project management tools that you must use. Number 1, a due diligence checklist. The one in the materials is 200-point due diligence checklist separated by all the 11 categories, which we'll cover. The second one is a master to-do list that you share with your team. You, your accountant, your attorney. if there's anyone else involved. But you keep that constantly updated so that you're able to manage the process properly, and you, the buyer, manage that list. Circulate it to everyone, make sure everybody knows who's responsible for what. And the summary reference sheets by categories, which breaks down all of the main categories that need to be investigated and the materials that you need for each one. That information in the course lesson on due diligence, everything is included in there for you, as we talked about in the last webinar on part 1 of due diligence. In commandment number 1 that we always talk about, we say we pay for the past, we consider the present, we buy it for the future. So again, the goal of due diligence is to validate what you've already learned, uncover any issues, and then determine, most importantly, what life looks like post-sale. So the information that you're able to validate based on what the seller provides is the past. It's the financials, the history of the company, who's in place, employees in place, contracts in place, etc. But you want to be able to walk away from due diligence, not walk away from the deal, but walk away from your formalized due diligence with a very clear picture of what's life going to look like for me as the owner of this business. What is the business going to look like in the future? That's why you investigate multiple categories related to the industry and competition sales, assuming all things remain status quo. What is the future probably going to look like based upon what I've learned? You want to organize your priorities during due diligence, and I urge you, do the tough stuff first. Any issues, regardless of what category it's related to, you have to deal with the tough issues at the very beginning of due diligence, because if you can't get them resolved, you don't want to spend a whole lot of time and money with your accountant or attorney and address an issue later on that you knew about early on and it can't be resolved. So the tough issues, those could be related to licenses that the business possesses, whether or not they're transferable or assignable, lease assignments, if there's any key employees, whether or not they hold any licenses, or they have to be part and parcel of the transaction going forward, any financial issues. So attack the big stuff first. And when it comes to due diligence, what needs to be investigated, it's only one thing, and that's everything. Here's the list of 11 that have to be investigated. Okay, Chris is having a good smile there. Thank you for that. So you got financials, you got the assets. The one with the little asterisk next to it, as we covered last week. So you got financials, you got assets, you got the sales function of the business, the marketing of the business, the employees, systems that are in place, the competition, customers, contracts, suppliers, legal, and corporate. Now, 2 categories on here, like, why aren't they here? Which is the market and the industry. Why aren't these on the list? Because again, those are the things that you need to investigate well before you get to the formalized due diligence. You're interested in buying a parking lot cleaning company that does commercial parking lot cleaning. Well, as soon as that business becomes of interest to you, you're buying one, let's say in my hometown of Boca Raton, Florida. I'm looking at one. Well, I want to know who else is in that business locally. Who else does it serve? What the number of potential clients that are in the area? How large is the market? Problems related to that industry that you could look up and find out if it's difficult to recruit people. What are the insurance costs associated with? What's the turnover in that industry? What are the metrics? So everything related to the market and the industry, you have to do immediately. So you get an understanding of it, because it's way too comprehensive for you to have to do that plus these 11 other categories during the formalized due diligence. Let's talk about the financials. Okay. So as it relates to the financials, I like to say it's only money, right? The due diligence goes way beyond the financials. And this is where educated buyers make the biggest mistakes, is in the investigation of the financials of any business. And the reason why they make the mistake, where I say educated buyers, I mean typically individuals with a graduate degree, a finance degree, an MBA, what have you. Almost all of them make the same mistake here, which is they spend way too much time on the financials, putting together these wonderful Excel spreadsheets of trying to predict the future in good, better, best case scenarios, digging into the numbers crazily, and end up spending 2 weeks of the 30-day financial due diligence of the formalized due diligence period related to the financials. It's It's not a waste of time, but it's a terrible use of your time. You want to be able to have the evaluation of your input related to your assessment of the financials either quickly or before you even start the financial due diligence, and then give it to your accountant to let them do their work related to the financial due diligence package that they are going to work on and prepare for you. You've got a lot more that you have to worry about. I get these unbelievable Excel spreadsheets from individuals. Look at, I mean, with these pivot tables and these scenarios or whatever, and they're all wonderful. But you know what? Oftentimes they're really useless because you're trying to investigate what you're getting. It doesn't just matter just to make these wild projections related to the future or exit scenarios. That's all great to contemplate, but that's not the piece in due diligence. It's also trying to predict the future, which is not the easiest thing to do. And if you can predict the future, let me know. We're going to Vegas tomorrow together. So you want to be able to spend your time on the important stuff of due diligence, hand it over to your CPA and let them do the bulk of the work. Financials are math. It's math. It is or it isn't. 1 + 1 always equals 2. They can take care of that. You have to look. We're going to, when we dig into the financials, we'll talk about what you need to look at, but let them do the heavy lifting of the financial piece of the due diligence. Much can be done before the formal period begins that we've talked about. And if you get into a scenario where you've not received enough information on any part of the business, for example, if you've gotten the P&Ls, but they're not complete, you're missing the current period, there's no trailing 12-month period, or you haven't gotten the balance sheet, or you didn't get your tax return, anything that you need to do to complete the first stage of the financial review, you have to make that the number one contingency on your letter of intent. So you have your letter of intent and you mark on there within X number of days, 2, 3, whatever, of the beginning of the due diligence of the upon execution of the agreement, seller needs to provide the following. So again, these are any items that are big category items that you have not yet received at the time that you submitted your offer. So you could look at those immediately. Again, make those your top contingencies in your offer, and they have to be provided within a short period of time. And again, you don't want to start the clock till you get everything that you need for your due diligence. The goal of the financial review is threefold. Number one, to validate. You confirm what's been presented, presented to you, and also what's been represented. Of course, you want to avoid the old cooking the books problem. So you want to make sure the numbers are accurate. You want to check out some of the underlying issues related to margins, capital expenditures, any rising costs. That is the validation process. You're also going to look at issues that are potentially impacting the business. Will customers still buy from you? Will suppliers still supply you? Will the key employees stay? Are licenses transferable? Are they assignable? Are the licenses with an individual? Are they with the corporation? All of these things that need to be validated. The second part is the paper trail, which is following the numbers, which is what your CPA, your accountant, is going to do. They're going to look at and tie in the tax returns to the P&Ls, the revenues to the P&Ls, to make sure, do random checks just as like they would do it at a year end, to make sure that the revenue is accurate and being reported properly. And the third piece being to uncover any inconsistencies, warnings, or outright lies or other BS. Those are the three overarching themes related to the financial review period. One other thing I do want to mention, if anyone is on this call, if you're a CPA, don't do the due diligence. Hire a CPA. I've seen it a few times. It turned out disastrous. One of the things I was just thinking about prior to this webinar is that a client she was buying a business, and it was printing related business. Her husband was a CPA, nice guy, wasn't going to be involved with the business. And she said, no, and he worked full time, but he was a CPA, but he worked in an accounting department of a company, and said he's going to do the due diligence. My words to her, and it happened to be a time where I was working with a buyer, I begged her not to allow that to happen. Said he's too close to it. If something happens up, you'll end up trying to talk him out of it. He'll end up trying to talk you out of it. You need an objective set of eyes. And if their level of expertise is not in doing financial due diligence of those type of businesses and sizes, he's not competent to do the due diligence. And unfortunately, I wish I was wrong, but unfortunately, I ended up being right. They missed a couple of huge pieces. Business ended up failing after a couple of years. And I'm not saying for sure that it would have happened another way, but you hire pros. You work with believable parties. This is a massive investment. Getting a good due diligence firm is not that expensive, and it's well worth it. Here's what you're the part of the financial view. The first part, here's what you need to do. Number one, when you get the set of financials from the business, regardless of when you get them, if the numbers don't make sense to you, I could guarantee they're not going to make sense to your accountant. So when you have to look at them first and see if they make sense to you and ask the appropriate questions. You're going to need 3 years of profit and loss statements, and you want to lay these out side by side. Anybody who uses the most basic accounting system, any seller can give you their P&Ls. You want them for the last 3 years, and you want them side by side on one report. It's much easier to look at. You need a balance sheet. You need a trailing 12 months profit and loss statement. If there's anything being referred to here as I talk that anybody does not understand, please make a note and we'll cover it. I'll be happy to answer any of your questions when we get into the Q&A. You want a current year-to-date P&L and from the corresponding period last year. So let's say you're looking at a business in April of a particular year. So you get the last 3 years P&Ls, then you want to get a trailing 12 months. So from May 1st, the prior year to April 30th of the current year. And you want to get the current year, January to April P&L, plus a comparison to January to April P&L of last year. And of course, the tax returns, which may only come later. So this is what you, the buyer, need to review. Yes, your CPA is going to go more in depth, but again, top line being, if the numbers don't make sense to you, they're not going to make sense to your accountant. And step two, as far as what the accountant's going to do, is this is what they are going to do. Say, get out of the way and let your accountant do the work. Just stay on top of them for timing. You let them know, here's in advance, here's how long I have to complete my due diligence period, and then stay the hell out of the way and let them do what they have to do. Use the master checklist from How to Buy a Good Business at a Great Price. It's a 200-point checklist broken up into all the categories. You can compare that with what the checklist that your accountant will give you, and you make sure you're attacking with all the items that need to review. You want to coordinate with your accountant related to timing. If you get into certain periods of the year where it's tax time, end of quarter, end of or tax filing time, or September when all the extensions have to be submitted for businesses, they are neurotic, they're busy, they're out of control. So make sure you keep them well informed in advance of when you believe you're going to be ready for the formalized due diligence. There's a few items here that I call the oh so uncomfortable items. These are items that sometimes sellers get a little put off when you request them or get into the conversation. If for anybody who has the video on, or I don't know how we do this, Sia, with the raising hands, but is there anybody here? Does everybody here know what a 4506 form is? This is for US-based businesses. A 4506 form is a document that the seller signs that allows you permission to get a copy of their IRS tax returns transcript directly from the IRS. Now, most people aren't going to overstate their income on their tax returns, but it happens where people will give you a BS tax return. It could happen. And so this is, they sign that, you submit it to the IRS, they send you the tax returns, a transcript. Now, it's pretty interesting because the reality is that when you submit this to a seller, if they sign it, you actually probably don't even have to submit it. It's only if they're going to give you some pushback. But some of them may be very offended. Well, what do you think? I'm fudging my tax returns? So when I say the oh so uncomfortable items, this is an item that you have your accountant request from their accountant. So it doesn't, you're not the bad guy. It's your accountant is requesting it. Purchase price allocation. When the purchase is completed, the total value of the deal has to be allocated for tax purposes, whether it's to goodwill, whatever it may be, whether it's to a non-compete, whether it's consulting agreement. And in this situation, unfortunately, what's good for the buyer is bad for the seller and vice versa. And so you allow the accountants to do this. between each other, because you have to submit this to the IRS upon closing. And if you sit down and try to negotiate this with the seller, I promise you'll never get it resolved. Accountant to accountant will get it resolved. I've never seen a problem where people couldn't agree because there are certain guidelines. But then again, when I say the oh so comfortable ones, you let your accountant deal with their accountant. And there could be some other sensitive requests. If the seller comes back to you and says, hey, your accountant's asking for a copy of our tax return. What's the matter? You don't trust me? Always use the out of, hey, look, I'm an amateur at this, right? This is my first time. I hired these guys. They're professionals. I'm allowing them to take control and do it. Of course I trust you, but I hired them for a reason, and let them take care of it, or we'll speak accountant to accountant. So you could just sort of play dumb and defer it completely. That's why you let them do a little bit of the dirty work if there's anything that's uncomfortable. So this is what they are doing. Let's talk about the financials and P&Ls, and here's what you're looking for. Generally speaking, this is what you're looking for. You want to look for, again, you're laying out 3 years. These are typically overlooked items. Margins, are they increasing or decreasing? Or is there any inconsistent line item expenses, things that have been cut, things that have increased? You see this frequently. Sellers getting ready to sell, one of their higher paid employees decides to leave, they don't replace him, but they need that position. And so you want to look for inconsistencies across line items. Insurance costs, very important. In some industries, costs are going through the roof. So what they're paying now may not be what you're paying later. 1099s versus W-2s. For many years, a lot of companies had people that were working for them in a 1099 relationship. For those of you who aren't familiar, 1099, they work as a contractor. A W-2, they're an employee of the company. As a 1099, you're not required to have any withholdings or employer contributions. It was a tax saving thing. In many cases, it was legitimate. In other cases, it was a way to save taxes. The IRS is very rigid now as to who does qualify as a 1099. So if you're buying a business and there's 1099 relationships, you want to make sure that, number one, they're accurate. And number two, if they're not, and those people have to become W-2 employees, you are going to increase your costs because you have the withholdings. That net, they'll wind up with the same money, but that lowers the adjusted earnings. One-time revenue events. And to give you an idea, client of ours, we were looking at a business and noticed that in the fourth quarter was always a good quarter. When it was digging into in the due diligence and the financials, the owner had a wonderful bill and rebill scheme going on. What they were doing is they had two of their larger clients. They would ship them an excess amount of goods in December to boost their numbers. And then they would credit it later on in the year. And they wouldn't just issue a credit note. They would give them offsetting inventory, ship them inventory to make up the difference. It was crazy. It was so elaborate, but we got it. Okay, we caught it. And it was quite easy to catch because we noticed there was one customer 2-3 years in a row put in this big ass order like in December, and sort of digging into it and realized that was the issue. So you're going to look for one-time revenue events. We talked about we're not replacing employees, or if there's marketing and advertising cutbacks. Another thing is to look for year-end workman's compensation and other insurance audits. Workman's compensation works in arrears. So when you pay your workman's comp fees at the end of your year or the end of the year in which your policy was written, they do an audit of what claims may have been made against it, and that gets built into the following year's costs as long as you renew. But if that, one business that I owned, our audit was in September. Well, what if someone came in and bought that business in July? Well, their costs would have gone up the following October. And so you have to look at that and find out when is that audit, and speak with the insurance company, because you will have to accelerate the audit. Meaning, if you're going to close the deal targeted to close it in July, they normally do the audit in September. You have to move up that audit to July, so that or you have an agreement with the seller that any increase in cost that you will incur because it will be a result of their events, that you keep money in escrow, and it's a holdback, and the increase is paid from that. But again, it's something to be aware of. You might need, again, we said you might need to accelerate the audit, but there's ways to solve for that. Let's talk about add backs related to overlooked items. if it's going to be an expense to you, it's not an add back. You'll see, you're going to look at businesses, they're going to give you a laundry list of add backs. Okay. First of all, of course, if it hasn't been expense, it can't be an add back. That's pretty obvious. But if it's going to be an expense to you going forward, it is not an add back, no matter what the seller tells you. They have, very often you see it, they have a pickup truck and they write it off through the business. Well, do you use that for any deliveries? Yeah. Well, it's not an add back because I need a truck also for the business. So again, if it's an expense, going to be expense to you, it's not an add back. You always want a detailed list and an explanation for all the add backs. So the longer the list, the more crap you're going to find. When the owners run their business like a personal ATM machine and put everything through the business, you hear some people say, "Oh, you could expense all kinds of stuff and take your honey out for dinner and go on vacations and whatever," and that's all great, and part of that is true, but it also leads to having to think about the mentality of the owner, because when you're doing all of that stuff, you're not necessarily doing important stuff related to the business about money that should be better invested into the marketing of the business. And that sloppy type of bookkeeping mentality bleeds into the other areas of the business. That's fine for them, how they run the business. I would never run a business that way. I would suggest you don't run a business that way, but it'll give you some insight into their sloppiness related to the business and whether or not, they chose to buy a new, $150,000 car for themselves through the business versus putting it into the marketing. Don't be afraid to push back related to ad backs. If they cannot prove it, you can't pay for it. End of story. That's it. And if it's an expense you're going to incur, it's not an add back. Family compensation. Very often family members are involved. They're undercompensated or overcompensated, or there's an exaggeration about what they do in the business, usually to the lower side, meaning, oh yeah, my spouse is here, but they don't do much work. They come in once a week for the books. Well, you need to prove that. Or, they have a child who's working there and it's a job that normally pays 75 grand a year and they're paying them 250. So it could be over and under, but be aware, one-time expenses that actually recur. So if they have lawsuits and they say they want to add back the legal fees, but every year they seem to have a lawsuit, it's no longer a one-time event if it's happening every year. And capital expenditures, future expenditures for assets that have to be allocated. We talked about that in detail in valuations. I don't want to get into it in great detail. Anyone's unsure about CapEx, watch the webinar in valuations, or get in touch with me and I'll walk through it again. But again, this is an add back. Brokers especially will list depreciation as an add back, but if you have to buy equipment to replace over the next couple of years, that depreciation add back has to be offset by how much it's going to cost you to replace that equipment. And hopefully everybody's clear on that. On the balance sheet, buyers do not usually take the entire balance sheet. You take bits and pieces of it, like inventory and what have you. Net working capital. I want to get into the weeds a little bit, but net working capital has become an item that has started to bleed down into smaller deals. In smaller deals and under a few $1,000,000, generally speaking, the seller is not leaving in net working capital. That's your obligation as a buyer. Okay. They're typically taking the cash, they're taking the receivables, they're paying off the payables, they're leaving you with the inventory and the assets to run the business. Similarly, the way you sell a house, they deliver to you free and clear. Net working capital only comes into play in larger deals. You can try to negotiate it. Most of the time, the seller will have no idea what you're talking about, but by and large, you do not get net working capital. That's usually in larger deals. If you can negotiate it, great, but don't be concerned if you're going to get major pushback at the lower end. And so you don't want to forget that you may be funding the net working capital. And I refer here to the misinformed searcher. This especially happens on this concept of buying distressed businesses, which is a complete waste of time, because in the first week you're there, you probably have to write a check into the business. So don't be, if you've looked at bigger deals and case studies or whatever, just recognize you're buying potentially a lower market business. Net working capital is not always part of it. Inventory, you want it good and resaleable based on sales history. Okay, this is especially important from obsolete merchandise. And again, because you're typically taking the assets of the balance sheet of inventory, you want to make sure that it's good and resaleable. Other things that are overlooked are bad debts. Know what that line item looks like. Typically it's, there should be a percentage. If you see any years that have gone way up or way down, understand and dig in what those are. Because going forward, you may have a client who's teetering on bankruptcy, and the seller took the hit, but they're no longer a client of yours going forward. Gift cards and loyalty programs. A lot of businesses have gift cards and loyalty programs. They don't expire in America. Loyalty programs are slightly different. Gift cards do not expire. So if they have $100,000 of gift cards, unused gift cards that which shows as a liability on the balance sheet, because the seller has to fulfill those, they're obligated to fulfill those. Well, what happens? You buy the business, and in course of the next month, all those people with $100,000 worth of gift cards start coming in to redeem their gift cards, and you got to furnish them with merchandise for those gift cards. So the way you look at it is twofold. Loyalty programs typically expire, so you could see how much is out there in loyalty programs, and here's what's due to expire. And gift cards, you can, if they have some good history as to what the redemption rate is, great. If not, you have to set aside money into escrow, and you review it at the end of a year or two to see what the redemption rate has been, and allow yourself enough money in escrow. Don't get suckered into not putting money into escrow for gift cards. Okay, because there's going to be a redemption rate. It's generally not 100%, but it's going to be something. So you want the money set aside. You don't want to offset it against the seller note. You want physical dollars putting into escrow. So if you have to, at the end of the year, say there was a 12% redemption rate, here's the amount that I'm going to give you back, or after 2 years. Make sure you're very comfortable with that redemption rate number. Customer year-end rebates. When you deal with major retailers, if that's your customer base, well, they get rebates at the end of the year, typically. Volume rebates, advertising allowances, markdown money, other credits. You buy the business in August, and by the end of the year, they send you a credit note for X amount of dollars, because that's what their year-end rebate was. You have to know what that amount is. And again, potentially money set aside or put into escrow. Product warranties, the same thing. What is your exposure? Work in progress is a manufacturing issue. It's an accounting function, but you want to get a handle, if it's manufacturing, what the value is of work in progress, because the seller typically wants to get paid for part of it, but you're going to do the balance of the work. So if there's a product that you sell for $1 and it costs 50 cents, and the seller has done 20 cents of that work, well, you buy the business, you're going to have to do 30 cents of the work. Okay. And not get back the full dollar. So, or the full profit. So the other thing is end of equipment leases. What happens to the equipment? Does it go back to the vendor? Can you buy it for $1? Do you have to rebuy the equipment? Employee bonuses, benefits, and future plans to be funded. Retirement plans, that there may be a contribution. If there's any bonuses, the seller is going to have to make a representation that they give you a list of all bonuses that are to be paid. It'll get paid retroactively, or that they have been paid, because the last thing you want, you close the deal, and then one of the employees comes up to you and said, by the way, George, the old boss, George, he told me when, I'm getting a $10,000 bonus this year. And so let me tell you how you deal with that. Let's call George. Right now, we're going to find out, because most of the time they could be full of crap, but say, you know what, we're going to call George right now. And if George says that is the case, that's why you want, sometimes if you have it, that's why you want to have a seller note and the right to set off. Prepaid expenses, security deposits, and other contracts, you're going to need to fund them. Everything that the seller has put down in security deposits, whether it rent agreements or utilities or what have you, they're typically going to get that back. You're going to have to refund those, or you're going to have to pay them over and above for retainer, whatever's easier, but they're things to understand. If you're taking over the accounts receivable and the accounts payable, again, you want to make sure that there's a mechanism to reduce what you owe the seller if you don't collect all the money. That's another big reason why I love seller financing, because you have the right of set off. So all these things, hopefully I didn't fill your head with too much crazy stuff, or seem that it's overwhelming, but I promise you there's a lot to do. But if you do it methodically, it's all manageable. It's just being organized going into the process. Let's talk about contracts. Contracts, by and large, your lawyer is going to take care of these, but similar to the financials, get a copy of every contract the company has and read them. You're not a lawyer. No one expects you to be, but read them, understand what they are. highlight what the questions are. I'm old fashioned. I'm an old fart. I like to print them out and I like to highlight them and answer my questions. And some of the things that I can ask the seller and other things I might have to give to my attorney. But again, you read them yourself first and understand them. But you need copies of every contract. They have to provide you with every contract or agreement, oral or written, licenses, including anything employee related. Just understand: are they assignable? Are they transferable? You want to review the contract before your attorney does, and note your question and clarify things that you can do or verify with the seller, or things that your attorney may need to review. The key issues, again, are these contracts transferable, assignable? Who's the party to the agreement? Sometimes it's the corporation. You can have a situation, if you're doing government contracting, for example, the contracts typically go to the corporation, between the government and the corporation. You may have to buy the business under a structure of a stock sale in order for those contracts to transfer. Some of these contracts also have change of control clauses. If a majority control of the business is sold, the contract is deemed to be null and void. Think about that. So you have to make sure that you're aware of that. There's ways to solve for them, get around them, no question. We'll cover them in a later webinar as far as specifics are concerned. The point being here, know what you're getting. Okay, read the contracts. You don't have to be an attorney. You just want to read them, and anything you're unsure of, you can ask the seller or have your attorney review it. A contract may be transferable or assignable, but it doesn't mean that it will be. You must confirm it in writing with the other party. We have one of our clients on the call right now. This is one of the things that we're going through to make sure that one of the main suppliers for this particular business was going to continue that relationship post-sale. Customer agreements. If the company sells to major clients or retailers, you again may need a stock sale to retain your vendor number. If anybody is looking at businesses that specifically sell to retailers, I've owned a couple of them. I promise you, you can't imagine how difficult this is to get a vendor number from a merchant like Walmart, Home Depot, Target, etc. It could take you 6 months. And so you don't want to have to go through that. So you may have to buy part of the business as a stock sale, another part as an asset. There's a structure to do that. But those contracts may be voided again if they're not transferable. And so the last thing you want to do is say, well, you know what, we'll just sign up. We'll just get a new vendor number from the client. May not work. So be aware of it. Okay, let's talk about the competition.
Do we not want to stop for Q&A?
Yeah, maybe I'll stop for a breath also. That's a good idea. Yes, thank you. I didn't have it on the presentation. Okay, we've got 7:22, plenty of time. You could unmute anybody and everybody, and we could spend 10 or 15 minutes going through some questions, and then we are going to open it up again for Q&A afterwards. So anybody raise your hands, and if it's something that's going to be covered later on, we'll let you know. Okay, Joe.
Thank you. For the add backs, do you usually push back on those prior to the LOI, or are you always doing that in due diligence?
Both. The ones I like to clarify what's on there. If there's ridiculous add backs on there, I know I'm going to have a hassle during formalized due diligence. So I might as well deal with it now, because I don't want the heartburn later on. So you want to get a list of what are the add backs, understand what they are. If there's anything that's clearly disputable, I absolutely would push back on it before an LOI, because if not, it's just going to become a bone of contention afterwards. So it's a little bit of a judgment call, but anything that's ridiculous, you got to push back. Because you'll have some sellers, they'll fight you on every one. If you get into something, for example, like there's no CapEx, that's one, for example, that I would look at more in due diligence, because I want to understand what that number is. I can't really guess at that point. I may offhandedly say to the broker, well, you added back depreciation, but you didn't put an adjustment for CapEx, see what they have to say. But that's a big thing that you probably need some more information to make your argument well. So I think it's a little bit of the ones that are really obvious or insane, yeah, push back right away.
And then for the family involvement, you said that they have to prove it. How would they prove that, or what kind of proof would you be looking for?
I want to understand their job. Specifically, are they going to stay? And once you understand their job, you will know, you could quite easily find out what it is, the cost to replace them if they're not going to stay. Some of them will stay, some of them won't. Not sure, some buyers don't even want them to stay, but the key is to understand their specific role and then determine, are they overpaid or underpaid?
Okay.
They tend to be overpaid and underworked. They're meaning like, oh yeah, if someone else is going to be a more difficult job. If they're underpaid, you have to get them replaced with the right person.
Right. Okay. Thank you.
No problem. I know someone put in a comment related to net working capital as example. I'm happy to have that conversation separately with someone, but because it's a detailed explanation. I don't want to avoid the subject, but I want to get into some of the other stuff first. I think there was a post I saw, see, as far as, can you explain net working capital? I saw that pop up on my screen.
Yeah, I did. It's from Luis. Could you elaborate on how to negotiate with the seller? I think, is that what you're talking about? The
Yeah,
NWC, networking capital?
on
Is
net
that
working
okay?
capital, again, it's a case of, and if it's in a larger transaction, it's very commonplace. In the smaller ones, it's not. If you go get a commercial loan, SBA loan, they're going to include some net working capital. Don't have great expectations. At the very least, they've got to leave you with the following. Smaller transactions, they are going to take the cash, they're going to take the receivables, they're going to take the payables. They have to leave you with an adequate level of inventory. That's the critical piece, and assets that are in good working order. And so as far as leaving money into the business, when you get into the smaller transactions, the sellers are going to tell you, I'm not leaving you cash in the business. And so the mathematical, I mean, the textbook definition is current assets minus current liabilities. So you could look at that. It's what are you going to need to fund? I will tell you the way I look at net working capital is I look at the business, what the business needs in working capital. I discount the activity of the business. I make an assumption that the business is going to drop by 25% for the first 3 months. That's when I buy a business. And I know it's drastic, but it gives me a big buffer. And so I look at that and say, if this business drops by 25% for the first 3 months, what am I going to have to use to fund this business for the first 3 months? And I make sure I have those resources. If you could negotiate some net working capital in the smaller deals, great. Usually doesn't happen in the smaller transactions. And whoever that was who asked that question, my email is readily available. If you want to send me an email separately, I'm happy to have the conversation and keep notes of it and share it with anybody else. But on an individual, it's very unique and very individualistic. So I'm happy to help anybody with that issue on any particular deal at any time. But it's unique to every deal for the most part.
Awesome.
Any other questions so far?
We do have one from Matt, and he's asking, I have a question about legal contract review. Will this come later?
No, go ahead and ask it.
Cool. So I am in the process of being in due diligence on a company. And the next thing that's going to happen is the broker has suggested that we use a attorney who we split the fees for. They do all the due diligence associated with liens, loans, outstanding default, stuff like that. We split the cost for that, and then they hold there's a down payment that's held in escrow. I'm trying to figure out, is that a good idea? Is that a bad idea? Is that a neutral idea? Should I be kind of barking to say I want to use my own attorney?
Matt, what was you said, is it a good idea? Is it a bad idea? The third one, did you say, is that an awful idea?
I said neutral idea. I mean, is it good, bad, indifferent?
Awful.
Okay.
And the reason why, the function of a promissory note, checking for liens, etc., that's pretty rote. I was going to say any competent attorney could do that, but that's making the benefit of every attorney being competent. So the problem comes in twofold. Number one, if there's any conflict, the lawyer doesn't represent anybody. They represent the deal. If there's any conflict or you have to go back if something's not done properly, who do you go after? You don't even want to do that. In these transactions, you want a lawyer who represents your interest. They don't represent the deal. They take care of you. Does it cost you a few more money, a few more bucks? Yes, it does. Are there certain documents when you hire your attorney, you can tell your attorney, look, the closing statement, the promissory note, The UCC filing, whatever is template documentation. I don't mind if we split the costs or whatever and let the other guy do it. But I would never let a neutral attorney handle any part of the deal in any way, shape, or form. Too much at stake.
Okay, so here's a follow-up question. And I am just trying to figure it all out. So I don't care one way or another. Having a neutral attorney do it and then having my lawyer review it. Do you think that's still a bad idea, or do you think
not necessarily? No, that's okay. That's not terrible. But I would like your attorney to hold the deposit.
Okay.
And that becomes depending where you're located, by the way.
Georgia, Atlanta.
Okay, so in the sale of a business in Georgia, I believe, is there a broker involved?
There is, yeah.
I believe there's some of the real estate law that applies to actually this transaction, similar to Florida, where if there's a dispute related to the deposit, if the parties can't agree, it's got to get submitted to real estate commission, who then does a ruling. There's a whole series of what has to happen. During your initial deposit that you put into place for due diligence, which you should be able to have language that allows you to get the refund of your deposit for any reason or no reason, at your complete and absolute discretion, right up to the end of the due diligence period without penalty. You want that held with your attorney. It's a benign deposit anyway. So anybody who gives you a problem, say it's a benign deposit. It's meaningless because I can get it back. And so when you get past that and you've signed off on the deal and you've signed off on due diligence, if an escrow agent has to hold the money, that is fine. Confirm with your lawyer they're okay with that, and make sure that the conditions allow understanding what the conditions are for closing in case someone doesn't, remove a final contingency or otherwise. To your idea of some of the benign stuff being held by a neutral third party and let your attorney review, yeah, that works as long as it ends up costing you less money. Because if your attorney's going to review it, they might look at it and say, look, I could review it, but it's still going to cost you the same amount as if I drafted it.
Well, that's the problem, is that, it may, I don't know, it may be half a dozen of one and 12 of the other. I don't know. I'll have to ask that question, but I agree with you, because I talked to the attorney and he seemed like a nice enough guy, but ultimately, to your point, he represents the transaction, not really anybody.
Yeah, so I'm sure he is a nice guy, but it doesn't matter. Right. So I think your inclination is correct. You could verify with your attorney. Again, I'm just of the ilk that I would rather have someone bigger, better, faster, smarter than me as an attorney representing me in the transaction. If I was going to spend, I'll give you an arbitrary number, 10 grand on attorney fees, and it's going to cost me an extra $2,500 to do the work that someone else would, I'm fine spending it. And I'm not trying to be a big shot. It's just, I want someone in my corner.
Right. No, that's super helpful. I appreciate it.
Of course, no problem. Anything else, kiddies?
Nope. Would you like to continue on?
Yes, I shall carry on. Okay. Let's talk about we're going to talk about competition. Personally, I love this part of the process. I think it's absolutely fascinating. I love due diligence. I love negotiation. And I find this just so compelling. There's a lot to be learned, because I go into due diligence knowing that even if the deal falls apart, I'm going to learn a lot. But I go into, again, we talk about confirmatory, but you could make this exciting. It's stressful, but if you get yourself organized, you can do this in a really good way. So when it comes to the competition, the goal is to gain an understanding of who they are, the competitors, how they compete with the target company, their marketing, advertising strategies, and their strengths and weaknesses. I've done it plenty of time where I'll get a friend of mine to go do the same thing at the target company. So I'm looking at a particular business. I'll get a friend of mine to call the business that I'm looking at and buying, and call them up and ask them about their products, or speak to one of their sales representatives, do some of the stuff that I'm doing to the target company's competition, and it gives me some insight into the target business as well. When you're dealing or looking at or speaking to competitors, obviously you want to keep your mouth shut as far as what you're doing it for. You're playing the role here. You never want to disclose what it is that you're doing specifically, of course. There's 3 stages of investigating the competition before you own the company. 1 is after first contact with a business. So you find a business, you've had an initial conversation with the seller, you want to get into looking at the competition immediately, which we discussed in great detail in the last webinar. It also helps you prepare for the meeting with the seller when you have a general understanding with the competition, so you can demonstrate to the seller that you're reasonably informed and have prepared yourself in a meaningful way for the meeting. So you're not going to get into the weeds or potentially get some incredible information, but just get a general understanding of what the competition looks like. And that could be done even through generic searches. And if it's geographical, just understanding the marketplace locally. As the second stage is, as you learn more about the business, you keep digging into the competition. And the third stage is in the formal due diligence stage, where you button it all up, when you really dig into the last pieces of the competition, as you learn more about the guts of the business that you were investigating. So again, there's 3 stages. The first one being as meaningful as the last one, because you've got to start immediately and you want to understand what's out there. And we talked about last week about a particular sleep clinic in Tampa that one of our clients was looking at. And the seller said to them, we're talking about competition. The seller says there's a handful of them. Well, initial investigation, we found 22. I don't know what kind of size hands you guys got, but mine has 5 fingers. So 22 didn't equal 5. When we talk about every business has competition, if you find a good business, as I describe a good business, that has no competition, buy it right away. Immediately. Don't even think twice. Because reality is it's not going to happen. Every business has competition, even if it not necessarily the product. They may be fighting for the share of the client's dollar. Information from the seller. Whatever information the seller provides is okay, but you have to validate everything. You are going to be stunned how little most sellers know about their competition. Stunned. It's absolutely staggering. For example, you hear, the seller mentioned that there are 2 competitors. Yeah, forget about it, right? I mean, that's just not the case, all right? You got to investigate it yourself. Use common sense when identifying the true competition, which means who is or who can impact the business. Talk about geography. Remember I think we alluded to at one point, we were talking about the moving and storage business, where the broker was talking about, it's a $4.6 billion industry. Yeah, but this guy's buying a shitty little moving and storage business in Omaha, Nebraska. I mean, that they do X billions of dollars across the states is meaningless. Understand who is the real competitor that could impact the business. And also understand what is the impact of online businesses on a local company. You may be buying a business that doesn't do any online representation, or may have, but there's someone else who's only online selling that type of product. They're not in a bricks and mortar business, but they are, by God, they're a competitor. So understand, how you look at this. I hate to use that term, but you're looking at it holistically, right at the beginning, like who could potentially impact it, and then you're drilling down to being realistic about who is the competition that can or could potentially impact the business. If you're doing, for example, I marked in here, there was a recent transaction that I was involved in, and they were in the manufacturing business in sports related, and they identified a couple of competitors that they said were in the industry. And sure enough, look there, and there were only a couple of competitors in the industry, but there were a bunch of them that were based in Europe, in Eastern Europe, as manufacturers, and they were shipping over to the US. And so this particular individual, they disclosed what they truly believed to be their competition in an honorable way. And there's 3 or 4 of them, and then found out there was a ton of them based in Eastern Europe, and they had a pretty substantial piece of the market. So competition, what to do? Visit or call the competition. Play the role of a customer. I always ask to speak to a salesperson if the business is appropriate, because salespeople can't stop talking. And so you can ask them all kinds of questions. We have that laundry list in the course that takes you through each question. But I'm thinking about buying one of your products. Tell me a little bit more about it. Understand when you call them up, when you speak to these individuals, and again, I prefer a phone call, not an email, if possible. How do they answer the phone? Do they get back to you on time? Do they seem effective? Is their website good? You could talk about, other customers, if it makes sense, if it's appropriate, a size business. But again, speak to a salesperson, dig in and find out, if you can get any sense for the size of their company or what they specialize in. And I often say, well, I'm thinking of buying from XYZ, why should I buy from you? Of course, you never, ever, 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 ever want to disclose the conversations that you're having with the business that you're targeting to acquire. You want to ask about price, quality, service, etc. And again, the point of consider buying same product from company X. What do you think? But just be cagey about it. But that's a brilliant way to investigate the competition. There are other businesses where you can actually physically go there. A plumbing supply company, or other retailers, or other businesses where there's walk-in trade. Go there as a customer. They're the competitor. You can go in as a customer, walk around, see the size of their place compared to the company that you're looking at buying, how they treat the customer, what their inventory looks like, etc. Play the role of a customer. What you want to learn about the competition. So the main things that you want to learn: the company size, their claimed competitive advantage, who are the owners, how long in business, potential size, if there's any client overlap. You're both selling similar customers. Well, you can ask the customers about them. And a lot of this is also stuff that you may learn afterwards. You want to understand what's their hook. How are they getting customers compared to the target business that you're looking at? What do they do well? What do they do poorly? What can I steal from them? What are ideas or initiatives that they seem to have that you'd want to implement into the business? How long have they been in business? You look online for reviews, complaints, potentially accolades. I read something recently. They said 87% of all customer reviews online are fraudulent. So take it with a grain of salt. There's actually one company right now that developed, to go off on a tangent, that developed this AI that's going to be able to validate whether or not a review is real or not. So it's worth looking at, but understand a lot of them are just, from friends and family. Product reports, can you get anything if it's a type of business where they provide spec sheets on reports? Get to their website, social media, product information, and pricing wherever possible. And ask yourself, if I were a prospective customer, who would I buy from? The company that I'm looking to acquire, or this or competitor, or another one? Now, post-sale, this is a separate note, and we have a whole category and lesson on post-purchase priorities, but it's worth talking about right now, which is, ladies and gentlemen, if you're going to buy a business, make understanding your competitor a company-wide priority. Be exhaustive about it. You and your staff must know the competitor like better than the competitor knows themselves. Understand this is a huge piece of business, huge part of your business. Make it a priority. We're going to go into the Q&A now, and this is open Q&A. Anything and everything you want to talk about, we can talk about. I hope you found the information so far helpful. We are going to have the next session on due diligence, which will cover 3 or 4 additional categories. The Q&A piece is something we also do, mentioned earlier, every couple of weeks with our clients. We're going to increase that potentially. So anybody who's currently using our course, if you send me an email, if you think you want to, if you think it would be helpful to have a separate, an additional Q&A session added, we'll do that. So let me know. But any questions that you wish to ask, hopefully you have a bunch of them, or if not, you're the smartest people I ever met. You can unmute everybody, Sia, and let them raise their hand or however they want to do it.
Hey, Richard, is there a way that as you're kicking off a due diligence period, that there's like a healthy balance of not overwhelming the sellers to say, here's my laundry list of activities, or do you just work that through with the broker? I wasn't sure that when I was asked by the broker in front of the owners, what would that process look like for myself? And I wasn't sure if I should be exhaustive to show that I'm well prepared, or do I need to make it sound simple and straightforward?
Well, if it really is simple and straightforward, as long as they present you with the information. You want to give them everything as early on as possible. If they have a broker involved, the broker is going to know, unless it's their first deal, that it's a pretty exhaustive list. And you can tell the seller the way I always categorize it with the seller. Look, there's a ton to do. Some of these items may not apply, but we're going to get through this in a good way. And a lot of this information you already have, your accountant has it, your attorney has it. So don't be overwhelmed. If there's anything you're concerned about, you'll let me know. But the thing is, you want to get everything out there to them as quick as possible, because you want to be able to, you have a limited time to do it. And the onus is on the seller to present you with the information for you to make an informed decision.
Right.
And if they delay, you know, if it's going way too slow, you have to extend the due diligence period, and you don't wait till day 30 to do that. That's why, the advice and the guidance that I suggest at the beginning is the key components of due diligence. The clock should only start when those are provided.
Right. Right. Okay. That's great.
No problem. Where you run into trouble, Britton, by the way, is if there's no broker involved, the seller's clueless. So you sometimes have to hold their hand. You got to do a little bit of, you got to be a Sherpa, right? And you got to explain to them, say, if you're uncomfortable, if it's too much work, instead of 30 days for due diligence, let's give ourselves 45 and we'll walk through this a little slower. And sometimes say, why don't we just have your accountant speak to my accountant and they can coordinate it.
Right. Right. Okay. That's great.
Perfect.
I do have a question.
Yes.
What would you say? I'm in the process of just starting due diligence on it's a medical staffing agency / X-ray tech company. They do 2.1 million in revenue each year. My question is simple. I noticed they don't have a website anymore. They have a link to a website, but it's not active anymore. So is that a red flag? I have a call with the broker tomorrow, and that's one of the questions on my list, but want to see your thoughts on that.
Well, the first thing is that's a question that I would ask the seller, not the broker.
Okay.
Because you want to understand they may have a reason for it. It may be the type of business where a website just doesn't produce results for them. Now, most businesses should have one, at least from a standpoint of being, even if it's just a simple glorified business card, right? So they should have one, but there's probably, well, I shouldn't say probably, Torrance, I should say hopefully there's a good reason that they don't have a website, but get that information from the seller. And I wouldn't say by no means is that like a potentially not even a red flag, definitely not a deal breaker. They probably have a logical reason why they don't have a website. And again, you bring up a real good question, because once you get into due diligence, you want to dig in as much as you can with the seller. The broker, and I do some brokerage work, so anything I say disparaging about brokers, understand I'm insulting my own community. I mean, the reality is they have one agenda. They want to sell you a business. They don't care if it's the right business. They don't eat if they don't sell the business. So the quicker you can establish the relationship with the seller, the better. And by the way, to that point, if there's any pushback from the broker, say, look, Mr. and Mrs. Broker, I have a question. I ask you, you ask the seller calls you back, you call me back. It's ridiculous. We've got a limited amount of time to get this done. I'm not going anywhere. So I'm happy to copy you in all the emails, but certain things that, if I have to ask the seller, I have to be able to send them an email or ask them a question. So I know there was a mouthful there, Torrance, but high level, no, it's not a red flag. Yes, it needs to be investigated as far as the website. You do want to investigate that with the seller and understanding how the best flow of information works when you get to the formalized due diligence between the buyer and seller directly as much as possible.
Good deal. And to your point, this is my third company, and the last two, the brokers played a big part of me not moving forward. It just seems like the brokers were a little shady, more or less, than the sellers. And just after doing due diligence and looking under the hood, it was like just too many red flags. And I think most of it was from the broker standpoint. So it's a good point.
Yeah, I mean, you carve them out of the equation, and you're not being disrespectful. Say, look, you're not getting screwed for your commission. I'm going to, the seller's going to pay you. It's just we got a limited time to get stuff done. And that's why, you look at some of the earlier webinars and we talk about interacting and visiting with the seller, establishing a real meaningful conversation and a good relationship with the seller is so important. I know in my work and intermediary work, the faster I can get the buyer and seller talking to each other directly, the happier that I am. I'm not worried about not getting paid. I do my job. So, but I want to get the buyer and selling talking to each other, because those are the two that are going to get a deal done. So when you start getting brokers that interfere too much or too controlling, whatever, oftentimes they, throw deals off the rails just because of their ego.
Yeah. Thanks a lot.
My pleasure. Thank you for joining us tonight.
So we do have a question, and I don't know if Rich, do you want to ask it, or do you want me to read it off for you?
Rich should ask it. I don't know who Rich Diaz. Yeah, he could ask the question.
Not sure if he's in a place to ask.
Okay, perfect. So why don't you ask it?
I
And
think
if
I'll
he
go ahead
can't,
and
you could
ask.
join us.
And Rich,
Go
you can
ahead.
always pipe in. All right.
Yeah.
So his question is 80 to 90% down on an online business in the gaming sector reasonable?
It's not reasonable, but it's actually quite common. If if it's, when I say quite common, especially in businesses that are growing, when you see a lot of that, they're growing, exponentially and making a lot of profits. It's somewhat of a SaaS business, or they get a high percentage of clients that recur, not necessarily recurring, they're reoccurring. So there's that part of it. I would never, I don't think, buy a business with 90% down in an industry where it didn't have the seller attached to the business, because in that industry, especially if it's online, they can open up down the road incognito in 2 minutes after you close the transaction. So some of these industries command higher multiples or higher percentage down, but I think you've got to be very, very cautious when you have that type of deal. If the seller needs to be attached to the business in any way, shape, or form, or there's any type of concern related to them competing with you in any way, shape, or form, then you never can put that type of money down on a business. Having said that, some of those industries are commanding pretty substantial down payments because they're in demand. And Rich, if you want to, I know you can't share confidential information on this call, but if you want to send me an email, I'm happy to look at it with you one-on-one and give you a little more guidance. No problem at all. Again, the things that when some industries get hot, the terms start to shift for the seller. I mean, that's just reality. That's supply and demand. But you got to be very cautious before you put down that amount of money without the seller having some skin in the game.
Rich says, perfect. Thank you. I appreciate it.
No problem. Anything else? We either got shy people, or we got the answers all taken care of, or we bored them all to death. It's one of the three. Are we good?
Okay. Andy, would you like
Andy.
to come up?
Yeah, sorry for the video. It's off, Richard.
Yeah,
But
okay.
but I wanted to understand about the diligence period. Do we do like a daily call with our deal team?
No. You want to keep that master list that we talked about in the last webinar. For those of you who didn't participate, you want to have a master checklist. This is a master list of items to be done, where you have the item to be taken care of, what date it has to be completed by, RP, which is who is the responsible party, and any comments. I like to update. I will potentially update my list on a daily basis, but I would only have a call as needed, because every time you have a call with your attorney and accountant, especially your attorney, you're going to be spending money, and you don't need to have a call with your lawyer just to check in. Is everything okay? What you want to do is you take it and you back into the date. So for example, you have 30 days, that, and you've set up your proper checklist, and the lawyer's going to tell you, here's the 12 things that I'm going to do. Great, Mr. or Mrs. Attorney. When are all of these going to get done by? They're going to tell you, well, as long as the seller provides the information. Okay, let's assume that they do. Then you want to say, you circulate that list and say, I want to get an update on it every few days. And if you're not, and advise your seller and accountant, if they're not getting answers back from the other party in an expeditious manner, you have to step in with the broker or the seller. But don't just get on the calls unnecessarily with your accountant and your attorney, because they're going to be charging you for that for no good reason. So a list project management tool should work effectively, but just don't let too much time slip by. Make sure that they are hitting their deadlines as well. So, I keep my list up to date daily, and then I circulate and say if there's any changes. The most important thing that you want to impart upon your team is the following. If you're not going to hit a date, you got to let me know. Don't let me know after the date. Okay. If something needs to be done by Friday the 17th, okay, don't tell me on Monday, like the 20th. Okay. You need to tell me on the 14th. Like, if you need an extension, that's fine. We'll work on it with the other party. But we've got to hit these dates, because if not, you have a bunch of things that you do and everything's running late, and you're just not going to get it completed by the end of the due diligence period.
Got it. Thanks.
Good.
Richard, I've got one question. This may vary from deal to deal, but specifically with a broker, when they have an asking price, is there any general rule of thumb in terms of what you should go in with your first offer? I've heard some people say that a lot of brokers price things about 0.5 times EBITDA higher than what they actually expect. Should I be kind of like thinking about this as you can always go a little bit lower as long as you're not being offensive, and you can always kind of come back if it gets rejected? Just any guidance about thinking about making those initial offers with a broker?
So I'll give you in a couple of ways. I don't pay any attention to asking price, none whatsoever. I may want to look at it after to understand how the seller was thinking about it, and have this common statement that whatever seller thinks their business is worth rarely has anything to do with the value. And so I completely forget about the asking price. I do and implore people to do their valuations on their own, come up with a price that makes sense and that it's defensible. We have this tool, the OMO business assessment, that takes 50 fundamentals into place, weighs certain averages, puts weight to certain averages, takes at least 3 years plus a partial year if necessary, and comes up with a valuation. Then it's defensible. The seller, and most of the time, they just pick their asking price out of their rear end based on what they need to retire or what a broker thinks they get. And understand, on the lower market especially, brokers will take a listing no matter what the seller wants for their business. And because the philosophy has been for the last 50 years, well, just get the listing, then you have the gain, because we could always go back and lower the price. So I don't pay any attention to the asking price. And I'm not worried about insulting the seller if my valuation is defensible. Because then I look at it and say, well, if the seller's insulted, then theoretically I should be insulted as well, because they've looked at it and said they've come up with an asking price that holds no logic. So I should be the one who's insulted. So I know sometimes it could be a little difficult. Say, geez, I like this business. I don't want to insult them. I keep coming up with my valuation. They're asking 3 million. I keep coming up with 2.2. If that's what you've come up with and you're being fair and reasonable and using a proper methodology to arrive at that price, there's nothing to be afraid of. They're insulted. It's actually their problem. And I don't mean to sound harsh. It's just the reality. The most important thing is you have to be able to defend your valuation, and you shouldn't pay attention to what anybody tells you as far as parameters. There's some brokers are known for grossly overpricing their businesses. There's other ones who try to make it spot on. Other ones don't. Most of my engagements, I don't even have an asking price. I try to give my seller a general parameter, but that's sort of anecdotal information related to here's how they may price it or whatever. Don't pay any attention to it.
That's helpful. Thanks.
My pleasure.
All right. I don't see any other questions on
You
the
don't-
queue. Oh, wait, hold
Okay.
on.
Okay,
Wait,
good.
we have one.
From Matthew. Yeah.
Do you want
Oh.
us to read it, Matthew?
Oh, yeah, I see it here. How do I saw something. How do you see businesses that I'm brokering? I actually keep them very most of the time confidential, because they're usually, I don't put them on businesses for sale or biz buy sell or BizQuest. My deals typically are like my sweet spot is usually about $2.5 to $7.5 million of EBITDA. The one I'm working on now, one is a retained executive search company. One was an e-commerce and retail that's now been sold to a marine manufacturer. I have a couple of others that were online that are coming online shortly. So Matthew, my email address is rp@richardparker.com. And if you want to send me an email, I'm happy to get you on the distribution list. It's not a big part of my business. I rep a maximum of 5 deals a year, only because I love that part of the equation. I don't chase. I don't even go out and solicit them. I've been doing this for a very long time, so I get a lot of opportunities, and I deal with people I like and trust and have nice businesses that I would potentially buy. But I'm happy to get you on the onto the distribution list. There was one, by the way, that I got. Okay. We know they'll be buttoned up for for due diligence. Matthew, I could tell you, I do more due diligence on an engagement than I guarantee that any buyer does, because I need it to sell. Like, if not, I spend so much time with it. I want it to sell. It's got to be priced right, everything in order. If there's customer concentration, I probably reject 10 to every one that I take. But yes, 100%, I promise you, they're those businesses are ready. They're nice and clean, and because I see things through a buyer's eyes. I've been doing that for a long time, and I bought 14 companies myself. I know what a buyer wants to see, and I won't bring a business to market that's overpriced. The goal is to sell it to, the right person. So I do appreciate your comment. There was, by the way, one deal. If anybody's looking, was I saw it recently. I don't know if anybody saw it. It was from another broker. I get these listings. I don't even know where it's located, but it's a company that manufactures parts for trains. For some reason, it caught my eye. I thought it was a pretty nice, bland, unsexy business, making about $1 million a year. And if anybody wants, again, send me an email. I'll just forward the email for the broker to you. But I saw it just not long before the webinar, and I thought that was I like those solid, stable businesses that fly under the radar. So if anybody has any interesting or so a little bit of background in manufacturing, what have you, I'll forward the email to you. I think that's pretty much it. We put in here, Sia, maybe when you have a chance, you could put in the link to richardparker.com just as some next steps. We're going to have next webinar in a couple of weeks. I'd urge all of you to go to richardparker.com. We have that. I built that whole website as a educational platform. We've got tons and tons of articles and free reports. We have podcast page there. I've been on 71 podcasts in the last 6 months. 55 or 56 of them are posted. So there's the information that can overwhelm you. You know that we have our course, How to Buy a Good Business at a Great Price. We have some pretty crazy success rates with it. 82% of the people who follow our course and use our consulting, which is included by a business in 6 months. So I can say that with great confidence and pride. So I'd urge you to take a look at that. These webinars, you have to use them to augment your learning. You're not going to learn how to buy a business by sitting on a webinar, as much as helpful as I hope this is for everybody. But these are tools to augment your learning. You have to have a blueprint, and you have to have knowledge, because what happens is there's a lot of competition going into this process. And if you're not fully versed and have a knowledge base, you're just going to come across other buyers who are going to be able to move much faster than you, and you're going to lose deals because of that. So you've got to go into this, lack of knowledge usually either equals big mistakes or lost deals. And the reality is, you've got to become a business buying expert. I mean, it's critically important. When you go in, I'm going to do a screen share for a second so anybody could take a look at this. Let me share this screen here. I think, yeah, see, maybe you'll put in the link, the one I sent you earlier to download. But basically, if you go to richardparker.com, and everybody can hopefully see this, when you scroll down, you're going to see the bullet points, of course, but there's this section here, which is the curriculum. So it's 23 lesson modules, and they're organized in the flow of the deal. And if you click on any of these, they will take you, hopefully you could still see us. Give me a thumbs up if you see why buy a business. So we take you through every step in the process. And in that course outline page, there's everything that's covered in each one of the sections. So you could really get it. This is not a product where you're going to get it and say, oh my God, it didn't live up to expectations. I guarantee you'll never believe how much value there is in here. But we lay this out in the steps of the business buying process, from things to consider at the beginning to what's the right business, getting organized, dealing with brokers, working with professionals, and then getting into gathering information, visiting the business, 36 key questions to the seller, financing, due diligence, negotiating. So it mirrors the steps in the buying process. And probably one of the most attractive things about it is we include free consulting. I've never went into this to make money. I made my money buying and selling businesses, not selling courses. And so to me, the most help that people need is as they go through the process, getting help as far as any questions or comments that come across. So I'm happy to help you at every step of the process, and that's always included. And the one thing I'll tell you is just get your information from believable parties. As you go through this, don't start falling for this bullshit of buying businesses for no money down and spending $5,000 or $10,000 on master classes. They just don't work, and you're wasting your time. So I hope you'll join our community. That's my fancy sales pitch. After this, go watch the prior webinars on due diligence. And I urge you to go back and read a lesson in the course, which is gathering information, and also the whole due diligence section. There's a summary reference sheets. The next webinar for due diligence part 3 will be in 2 weeks, which is today's the 12th, so 14 to 26. Well, it'll probably be the 25th because the 26th is my anniversary. So I'm not going to do it on that Wednesday night. We'll do it we're not going to do it on Wednesday. We'll probably do it Thursday or earlier in the day. And for clients who follow the program, we're going to have a Q&A next Friday, June 21st, I think at 3:30 p.m., but we'll send out an email directly to you with that link. And the last thing is, if you decide that you want to follow the materials, you'll see on our website, there's a two courses: how to buy a good business at a great price, and the due diligence mastery program. You do not need to buy the due diligence program. It's included with the course. So don't order the two of them. And so here's everything. Here's the beauty shot, everything you get with the materials. And so if you have any questions, just let us know. And I appreciate everybody participating. And it's good to see everybody. And I thank you for your time. And hopefully you found this helpful.
Hey, Richard, can I ask one last question?
Of course.
Just quick, is this what platform is this course? Is it a book? Is it video? Is it
PDF, Excel, and Word, and it's all downloadable.
okay? Gotcha.
The Diomo Business Assessment which is the evaluation program that we developed, was based on 1,017 transactions. That's in Excel. You just plug in the information. The rest of them are in PDF by section. And the ancillary interactive resources and the resources to print are either in Word and Excel. What we did was these webinars, I mean, it would have been very easy to take out some of these webinars, package them up, and say, we're giving you 20 hours worth of videos, what have you, but I like to make those available to the public. So I look at this, and you use the material as your foundation, and then take a look at the videos that are on YouTube, because they augment your information. Same like the articles on our site. They augment the information, but this breaks it down into each of the stages of the process, and case studies, what have you, and legal forms, letter of intent templates, offer to purchase agreements. Everything is included, all the exhibits.
I'll be getting mine today. Thank you, sir.
Appreciate it, Torrance, and nice having you. And again, if you have any further questions, let me know.
Will do. Thanks so much.
Okay, guys. Thank you.
Richard, I have one last question. There's a minute. Yeah.
Okay, sure. I can't see you, but I hear you.
Yeah. No, because I don't look as good in real life as I look in the photo. So
You
that's
look
why.
better. You look better. You look better. You look better in real life. There's no doubt. It's like, what's his name? Jemiah. He's got this beautiful white suit on in his picture, but I like seeing him live in person. Okay, go ahead, Andy.
Yeah, no, so I heard there's unlimited consulting with the course, with just that much price of the course, because that sounds too good to be true. To
Thank
have
you.
the
I
unlimited
appreciate that.
consulting with you one-on-one.
Me. So here's the thing. You know what? I had a note, but God bless you, because I had it here here, I'm going to show you, because I always have, when we do these webinars, I always have the housekeeping items at the beginning that I talk about. And I had a note in here, we're talking about the course. I said, I hope you think it's too good to be true, but it's true. You know, I never went into this to make money. I never went into this to make money. I just want to help people. I know some people will think that it's a swan song, or it's not. That's my only goal. I've done very well in my career, and I'm very happy, and I enjoyed this part of it. I get totally, my blood boils when I see some of the stuff that people are paying money for online, and $10,000, $25,000 for consulting, or these other nonsense programs. It just drives me absolutely bonkers. So like, you're overpaying for shit information. Sorry, but that's the reality of it. And so to me, I wanted this to be a no-brainer for people. I give people a lifetime money back guarantee. You're not happy, send me. I don't need the money, so you could send me back anytime. And I love it when people say it's too good to be true. I realize we probably lose orders that way. People come to the website, say there's no way, but it is. That's what it is. There's no upsell. You're not going to get a barrage of emails from us after trying to convince you to join a master class, or we just don't operate that way. I'm happy to answer emails. I would say that 99% of the consulting is done via email, because people want a record of it. When you get into the throes of the deal, I'm happy to get on a call with you for 15, 20 minutes or whatever to walk you through something. So yes, it's all included.
Lovely.
Can I raise my hand here, Richard? So Andy, if you don't think it's enough and you just need to spend the money, I'm always willing to accept funds. So I'm throwing it out there for everybody else. Okay. No, but I mean, guys, I know he mentions me as being behind the scenes. I too have my own business, and I just got to tell you guys, $197. I actually told him he needed to raise the price, and he refuses to. So I'm the mean person. But if you guys could, for those that have not invested, it's just $200, you guys. That's like 5 cups of coffee at Starbucks. And if anything, Now you've got
It
a
probably
wealth
is.
of information. I mean, and if you really need to spend money, people, I am here. I am here for you. That's all I'm
Sends
saying.
you money. I'll give you her Zelle account. Thank you. I appreciate that endorsement. Andy, I read a story years ago. This guy, his name was Joe Gandolfo. Just digress for a second. He was an insurance salesman in the Midwest. This is in the 1990s. And he wrote policies mostly with farmers, and they're very lucrative policies because you have crop insurance, you have the house insurance, you have the equipment. So insurance policy for farmers is very lucrative. It's also very expensive, and it's led to the demise of some farming families. But there was another company in the insurance business that wanted to get into that industry. And so he was the top salesperson in the industry. And they went to him and said, look, we want to penetrate that market. So we want you to go back to every one of your policyholders and in the industry, or anybody that you come across with a policy. We will beat any policy whatsoever for 20% discount. We'll give them 20% discount, the exact terms, condition of any policy. We just want to buy the business effectively. So go in, take the policy. We'll do the exact same policy for 20% less. So he goes about this, and his guy's name was Joe Gandolfo. And he goes about doing this, and he's writing, of course, plenty of policies. But he was asked, and someone who I'm friends with knows him because they were part of an insurance group, top of the table. It's called the top. It's like the top half of 1% insurance agents in North America. And they were talking about follow-up. He said, and here's was his strategy. When he would go in to see a client and say, look, we're going to take your exact policy. I have this company that I represent, which is AAA rated insurance company. We're going to underwrite the exact same policy, and we're going to give you a 20% discount. If anybody didn't sign up that night, he never spoke to him again. And the reason was, he said to him, and I don't want you to take this as my same tack, but he said to him, if anybody's too stupid to figure out that they should buy right then, he said, I have no time for them. I don't want to waste my time speaking to them any further. And when I read his story years ago, I said, one of the keys for me to be successful in business is I've got to make any product I sell, and I've owned a bunch of companies, I want to make it a no-brainer for my customers. I want them to get to I want this to be the easiest buying decision they ever made. And it's always proved to be a good formula for success. I mean, if you make it in such a way that someone, they got to be out of their mind not to buy it, then that's the way I believe you should craft or build your company. It vomits quality and volume and value. That's a good part of why we always kept it as it is. And I want it to be affordable. I mean, it should be the easiest decision people make.
Right.
But if you don't buy it, you're always welcome on these webinars, irrespective of that. Always.
Right. And if we buy it, there's other webinars that happen which are only
Yeah.
for people who
Yeah,
are.
we do Q&As. We do Q&As every 2 weeks with our client. We're going to probably increase those. And then these webinars, we probably in the fall, we may change and go to a subscription base, where we have these webinar. People pay a monthly fee to participate in the Q&As webinar, but everybody will be grandfathered in. So nothing will change at this point. And so every 2 weeks, at least there's a Q&A only of our clients.
Perfect.
Can I jump in? Guys, could you please like and subscribe to his YouTube channel? At
Yes,
least
that'd
do
be nice.
that,
There's
please.
lots of good videos there, by the way.
There's
Take a
really
look.
some great stuff. And then, of course, there's also business buying banter, which
Oh,
is
I gotta
another.
halt you. There's my friend Daisy. I keep seeing all this wonderful picture of her, and I got such nice emails from her. And then she read her. She read her. Did you read what she posted? Thank you, Daisy. I really appreciate that.
I'll read
you're
it.
so welcome. You're so welcome, Richard.
Thank you. Nice to hear your voice finally.
Oh yeah, you know what? Next call, I'll turn my camera on. This way we can, see each other face to face. So
Yeah, it's much better. That's why I love doing the calls this way. It just humanizes everything.
Oh yeah, I understand. Yeah, guys, get the course. It's great. Seriously, the best money I've spent, honestly. So much information there.
Thank you. Very nice of you.
You're welcome.
Great. And so everybody, will see you in a couple of weeks. And anything in the interim, always email me. See ya. As always, thank you for your time. She'll have the video of today up in it's always 3 to 5 days typically. Probably Monday or Tuesday is more realistic of today's session. And you can go take a look at the prior ones as well.
Yep. Excellent. Thank you, everyone.
Appreciate everybody's time. See you later.
See you guys.